All right, let's unlock some serious market secrets today. Imagine having, well, not quite a crystal ball, but something close for the U.S. tech market in 2025. We're uncovering the ETFs that are absolutely crushing it. You're about to get a shortcut to being incredibly well informed with insights and facts that honestly might just surprise you. You're with a deep dive. This is your analysis. Today, we're plunging into a really comprehensive analysis. We're looking at three key players in the tech ETF space. We're going to pull back the curtain on their incredible performance, dissect the powerful forces driving their growth, and crucially, uncover the risks you absolutely need to monitor. Stick around, because the picture emerging from this data is pretty compelling.
Yeah, absolutely. But before we jump into all the fascinating details, it's really vital to remember this deep dive is for educational purposes only. We're breaking down complex info to help you understand the landscape, right? This is not investment advice. Our analysis here, it combines insights from, sophisticated AI models, deep research, and human expertise just to give you the clearest, most impartial picture possible.
Okay, great disclaimer. So let's start with maybe the biggest question. Why is tech not just doing well, but genuinely dominated the markets in 2025? What are the fundamental shifts driving this incredible momentum?
Okay. Well, what's truly foundational here is that this dominance isn't just random luck. It really stems from three core pillars that are, well, reshaping the economic landscape. First, artificial intelligence.ai. We're seeing an unprecedented boom, really, in generative AI capital expenditure. Companies are just pouring money into data center infrastructure and developing this whole new generation of AI-enabled applications. It's not just a trend. It's like a massive retooling of global industry.
A retooling, yeah. Okay.
Yeah. Second, there's the accelerated cloud migration. Businesses are just, continuing to move their operations to the cloud. This drives sustained, almost insatiable demand for cloud services across pretty much every sector. This digital transformation, it just keeps going, relentless. And third, semiconductors. Remember all those supply chain issues? Well, they're largely normalizing now. Combine that with record software margins, and you get this robust, sustained growth supporting the entire semiconductor ecosystem.
Wow, okay. It really sounds like a powerful convergence, a perfect storm of tech forces almost.
Yeah.
So what does this ultimately mean for the broader market and, particularly for how investors are getting access to these opportunities?
Precisely. The tech sector has, undeniably led the post-2024 market rebound, no question. And what's particularly insightful here is how ETFs fit into this picture. They offer investors diversified, liquid access to this huge innovation wave without having to pick individual winners, which is incredibly difficult, right? Especially in such a fast-moving space. Plus, they benefit from institutional adoption and scale advantages that are just hard for individual investors to replicate on their own.
Okay, yeah, that makes sense. Let's talk numbers then, because that's where the rubber really meets the road, isn't
Yeah.
it? For anyone wondering if this tech dominance is just, hype, the actual returns are pretty striking. What have these funds actually delivered?
Yeah, the numbers really speak volumes. The performance metrics for our three key ETFs, looking over the past 2 years, so 2023 to 2025, QQQ delivered a nearly 50% price return, 49.7% to be exact. VGT clocked an even higher, an impressive 51.9% price return. And XLK, while maybe slightly behind the others, still posted a very, very strong 47.5% price return.
Wow, I mean, those are genuinely significant returns in, what, just 2 years? How do those figures really stack up against the broader market, like, say, the S&P 500?
Right, context is key. If we place this performance in that broader context, QQQ, VGT, and XLK collectively delivered total returns ranging from 47% up to 52% over those 2 years. Now, to put that in perspective, they outperformed the S&P 500 by approximately 14 percentage points.
14 points.
Yeah. And what's particularly telling right now, today, is that investor flows into these tech-focused ETFs have been accelerating significantly year to date. It signals a clear rush by investors, actively seeking exposure to this surging AI theme they want in.
That investor behavior, yeah, it really highlights the conviction behind these trends. But, okay, impressive returns often come with a bit of roller coaster ride, right? Let's dig into the actual volatility of these ETFs. What do those risk metrics truly reveal about the journey for investors? How bumpy has the ride been?
That brings us to a really critical point, understanding the risk involved. Let's break down the annualized volatility and the Sharpe ratio for each. For QQQ, we see an annualized volatility of about 21.0%. That just means its price fluctuated, on average, by that percentage over a year. And it has a Sharpe ratio of 0.86, which basically tells you how much return you're getting for the risk you're taking.
Okay.
Then VGT, it has a higher annualized volatility, 24.7%, and a slightly lower Sharpe ratio at 0.77.
Okay.
XLK is pretty similar, 24.6% annualized volatility and a 0.70 Sharpe ratio.
So a bit more bumpy for VGT and XLK historically.
Historically, yes, based on that 2-year average.
Yeah.
But here's what's truly fascinating right now. The current environment for these funds. The volatility for all 3 ETFs is actually well below that 2-year average, considerably below. It's sitting at a surprisingly calm 12-16% right now compared to that 2-year mean of 19-23%.
Really? So it's actually smoother sailing at the moment.
Exactly. This significantly lower current volatility, it creates this, well, surprisingly supportive environment, especially for certain strategies like trend following. It's almost unsettling how calm things appear given the massive growth happening underneath.
Huh. That's a crucial piece of context. A calm ride during a high growth period. Interesting. Now, let's maybe broaden our perspective a bit. Look at the competitive landscape. How do these specific tech ETFs compare to their peers and to broader benchmarks like the S&P 500, especially when you look at valuation and maybe future growth potential?
Yeah, good question. What really stands out here is that tech ETFs, generally speaking, trade at about a 40% premium to SPY. That's the S&P 500 ETF.
40%? Wow, that's quite a premium.
It is. However, this premium isn't just arbitrary, right? It seems largely justified by their robust double-digit earnings per share growth. They're growing much faster. Take JTech, for example. It offers the highest growth potential we see in this peer group, something like a 23% 3-year compound annual growth rate. Huge. But it comes with a significantly higher price-to-earnings ratio, a PE of 41.0, so you pay for that growth. In contrast, VGT provides what looks like a remarkably balanced exposure, strong growth, 19% EPS KGR, but a slightly more moderate PE of 39.5.
Okay, so a trade-off between growth potential and valuation.
Yeah.
Makes sense. So when we zero in on our main 3, QQQ, VGT, and XLK specifically, what are the key insights when we break down their individual valuation multiples and growth rates?
Right. So again, these tech ETFs trade at that roughly 40% premium to SPY, but like we said, their earnings growth seems to support it. Among our 3, VGT actually shows the highest P ratio at a 39.5, and that's coupled with its strong 19% 3-year EPS SAGR. XLK offers, maybe, a more balanced valuation profile. It has solid 18% growth and a 6.8 times price-to-sales ratio. And then QQQ, it provides broader cross-sector exposure, not just pure tech, which results in a slightly lower PE of 32.5, but still a very solid 17% growth projected. So you see, each offers a slightly different blend of valuation and growth focus.
Got it. Different flavors for different appetites, perhaps.
Yeah.
Okay, beyond the raw numbers and ratios, what are the analysts, the experts out there actually projecting for these ETFs? What's the general consensus on price targets and ratings for the near future?
Well, the analyst consensus for all 3 is actually quite optimistic. It seems to point towards continued upside. QQQ holds a moderate buy consensus rating with an average target price around $570. That suggests maybe a 7% upside from current levels.
Okay, moderate buy, 7% upside.
VGT also carries a moderate buy consensus. Its target price is higher, around $725, indicating maybe an even better 8% potential upside. And XLK, similar story. Moderate buy consensus with a target price of $256, which analysts consider broadly sort of in line with expectations, but still positive. And, to give you a little more context for these optimistic targets, there was this quote from an analyst at Evercore ISI back in mid-June. They said, and I quote, "AI-driven earnings revisions have room to run through 2025 as hyperscaler capital expenditure doubles."
Oh.
Yeah. So that kind of industry-level forecast really underscores the potential that analysts are seeing in these ETFs.
Okay, you're getting a serious deep dive into the forces shaping the market right now. If you're finding this analysis valuable, maybe now's a good time to hit that subscribe button. Just a thought. You won't want to miss our next breakdown of critical market trends. But okay, every opportunity comes with risks, right? And a truly well-informed perspective means looking seriously at potential downsides. What are the most significant risk factors an investor needs to be keenly aware of when looking at these tech ETFs?
Absolutely crucial consideration. And there are several distinct categories of risk we need to unpack. On the macro side, these are generally high beta assets. That just means they tend to be more sensitive to overall market swings. So for instance, a 1% hike in interest rates, that's 100 basis points, could realistically lead to maybe a 10, 12% drawdown in their value. So interest rate sensitivity is definitely there.
Okay, 10, 12% from a rate hike. Noted.
Then you have geocyber risks, things like an elevated cloud attack scenario that could potentially impact operating profits, the EBITDA, by maybe 3–5%. Regulation is another one to watch. Rising regulatory pressure, perhaps something like a new AI Act, could add, say, 80 to 120 basis points. That's 0.8% to 1.2% to a company's SG&A expenses. Costs go up. Fortunately, liquidity risk seems pretty low for these big ETFs.
Yeah.
Their bid-ask spreads are typically tiny, less than 2 basis points, and they have really deep options markets. So getting in and out isn't usually an issue, but here's where it gets really interesting. And honestly, it demands constant vigilance. Concentration risk. This is, I would argue, by far the most significant risk factor for these ETFs right now.
Concentration risk. Okay.
Yeah. The top 5 holdings within each of these funds, they represent a substantial portion of the total weight. We're talking ranging from 40% up to a staggering 56%. Let me put some numbers on that. For QQQ, the top 5 holdings account for 45% of its value. For VGT, it's 52%. And for XLK, it's a really significant 56%.
56% in just 5 companies.
Exactly. It means a massive portion of the ETF's performance is tied directly to the fortunes of a tiny number of giant companies.
So, okay, spell that out for our listener. What does that extreme concentration actually mean in tangible terms?
Yeah.
If just one of those top companies, say, hits a rough patch or has a sharp downturn, what's the real impact on the whole ETF?
Right. It raises a really important hypothetical, but it's a very real risk. Get this. Consider a 30% decline in just one major holding, like NVIDIA, which is huge in many of these. That single event, a 30% drop in NVIDIA, could alone reduce the ETF's net asset value by a startling 3% to 7%.
Wow, from just one stock. That's insane.
It is insane. It's a massive potential impact from just one company's performance. It really underscores why this concentration risk is something you simply cannot ignore. It demands constant vigilance.
Okay, what an eye-opening detail on the true nature of that risk. Puts things in perspective. So, after this really deep dive into these top tech ETFs, let's try to distill it down. What are the absolute key takeaways for you, the listener, looking to be well-informed?
Okay, bottom line. First, tech leadership. It remains undeniably intact. Those powerful forces, AI-driven earnings growth, accelerated cloud migration, they look set to continue supporting tech sector outperformance probably through 2025.
Okay, tech leadership holds.
Second takeaway, VGT seems to stand out. It offers what looks like optimal exposure, particularly to mid-cap software. It demonstrates that strong 19% EPS HEJDAR, but with more moderate volatility compared to some peers. So potentially a compelling risk-adjusted option.
VGT for balanced exposure. Got it.
And finally, third, monitor key risks. It's absolutely crucial. Especially stay vigilant about that interest rate sensitivity we talked about.
Yeah.
And critically, that very high concentration risk within the top holdings of these funds. Know what you own, right?
Right. You came here for a shortcut to being well-informed. And hopefully, this deep dive has given you exactly that. Those core nuggets of knowledge and insight you need to understand this dynamic corner of the market. We've unpacked how these tech ETFs are performing, what's driving them, the risks. But here's something to think about. If just a handful of companies hold such massive sway over these major funds, what broader implications does that level of concentration risk have for the overall market? Beyond just these specific ETFs, it's definitely something to ponder as you continue your own journey of discovery and insight. Let us know your thoughts in the comments.
Absolutely. There's always more to learn, and understanding these interconnections is really key to navigating today's markets, isn't it?
Couldn't agree more. That's it for this deep dive. Stay curious, stay informed, and we'll see you on the next one.